Hey everyone, Brandon here from B2R Investing and Financial Talk. I've got a guest here I've been looking forward to visiting with. Many of y'all know I've mentioned I read lots of books, and in my 30-year career, I've read hundreds of books. And I would legitimately, and I've shared it with friends just recently, I would put this book when it comes to financial stuff and real estate in my top three. I have not mentioned that to him, but I would put that in my top three. Millionaire Next Door, Rich Dad, Poor Dad, and now Timeless Wealth. And I know he knows those books.
Oh
That is
yeah.
where I put it.
That's a big deal. Thank you.
And I really believe that, and I'm sharing this with others, and I'm looking forward to this interview. Arie, introduce yourself.
Thank you so much for having me on. And I'm humbled to be put in the company of those books because both of those books were game changers for me. So to be in that company is a huge deal. So I'm Arie Ben Gemmeren. I'm the founder of Lombard Equities Group, which is a West Coast multifamily real estate investment company. And I run the Timeless Investor show and Timeless Investor newsletter, which is really building upon the application of the Timeless Wealth book. So, kind of the timeless platform of taking history's great lessons and applying them to wealth building, wealth creation with a focus on real assets. So, that's who I am. I have four children, live in Portland, Oregon. Happy to talk about that experience as well. But yeah, great to be here, and thank you again for reaching out. It's a pleasure to be here.
Yeah, so let's get started. I would love to ask my very first question is what inspired you to write the book, and what was there a personal turning point or a story behind it?
Sure, definitely. So it's kind of a long-winded story. So I studied history in college, and I graduated into the teeth of the Great Recession with a history degree, studying pre-industrial European history out of UC Davis, so University of California at Davis. And when I first got into the workplace, I regretted having studied history. It was tough. It was 2009. I was trying to find a job. There was no jobs. Anyone on this call that's old enough will remember that time. And I regretted having studied history. And I kind of got into the finance business. I started my career at a very large money management company, was working in the equity research department, and I taught myself the basics of finance. I studied for the CFA, but I always had that history grounding. And I was very fortunate in the first place I ever worked. Fisher Investments is the name of the firm. Ken Fisher is the founder of that firm, and he was
Yes.
a big believer in history teaches, it doesn't repeat, but it rhymes. We need to understand these things. And he had like a recommended reading list of incredible books throughout history that influenced how he thought about investing, right? So one of them was The Great Influenza, which was a really interesting read too, which I'd recommend, which covered the Spanish flu. And so when COVID came out, he was able to draw on historic examples of pandemics, what happened in the Spanish flu, what happens in these different things, social unrest, things that come out of it, really applying the lessons of history to how he thought about managing a 100, $200 billion portfolio. And I was in his equity research department. So he was very inspiring. That experience taught me that finance and business, you learn it on the job. You're going
Right.
to pick it up much more, in my opinion. And I'm not going to talk too much smack about studying business in university, but my opinion is you learn it on the job. You
Right.
might as well use your education to learn thematics, trends, understand things. And I came to realize that the history background was a real value. So studying it, being passionate about it for my whole life, and then getting to kind of be in the equity research group and hear Ken talk every day about what he was doing was really inspiring for me. So fast forward, I went to work at Goldman Sachs. I was there for about 5 years in San Francisco, continued to have these incredible conversations with huge wealth builders, guys that built massive companies, that built huge real estate portfolios, and starting to see some of these commonalities and trends. So I'd always been inspired to write. Like writing has always been a passion of mine. I never had a way to really do it. And I started my company and we got into multifamily investing. We have a very specific thesis on West Coast urban locations, kind of a contrarian investment thesis. And I said to myself, I really want to write a book. And there's a lot of how to do real estate books, many, right?
Right. Right.
I did an interview with Rod Khleif. I was actually down in Sarasota to do an interview with him. And I was like, oh, I just wrote a book. And he goes, please tell me it's not another how to do real estate investing book. And I was like, Rod, it's not. This is the thesis of the book. And he's like, that's awesome. Like everyone's writing the like, this is how you buy a duplex and blah, blah, blah. And
You're
like, let's
right.
do something different.
There's
So
100 books out there that way.
there's so many books like that. And it's not like I'm going to add any value to the writing world by doing something like that. So I was like, we often look at history when we think about how we invest, trends, thematics. And so I came to this idea that why don't we investigate and learn the stories of historic wealth creators over time that use real estate, but not like a Sam Zell focused book. Like, let's go back to the Roman Republic. Like, let's look at these different eras of history, find the guys that did something and what are the trend, what can we learn from this example? Because real estate's one of the oldest, I mean, it's not the oldest business, but it's one of the oldest businesses
Right.
on earth, right? So how can we learn about it? So that was kind of the premise of it. What really drove the writing of it, I had my fourth child, and when my wife and I would trade on the hours in the night. So I'm an early riser. I get up really early. So I said, listen, it's a little earlier for me, but I'll start getting up at 3 a.m. to take the baby so you can sleep from 3 to 8 or 9, get your full rest.
Yep.
And the baby would sleep next to me or sleep on me. And I was like, you know what? I've been working on this concept, this idea. I'm going to hammer down in these early morning hours when the baby's sleeping next to me and just work on this book and get it done. And that was really the catalyst. It was like fourth baby, family's growing, business is growing. Let me write this book. And it was mostly done in the hours of 3 to 8 a.m. every morning before the other kids woke up, and intermittently feeding the baby and working on it. But that's kind of the story of how it came to be. So
That's interesting. When I read this is between 5 and 7.
okay,
I get up
okay,
early, and that's where I have quiet time in the house. Now, I've got older kids. Mine are 19, 18, and 13, but they're all still asleep. My wife is too. I get
yep.
up, and that's when I get that good, quiet time to read the book. So let me go into the next question. As you were writing this and doing your research, what do you think was one, if you were to put something as one of the biggest revelations from your study, because this had to be done with research, what would you think one of your biggest revelations was?
It's not going to sound that novel, kind of spoken out loud, but a long term orientation. Like I think we tend to think in terms of 3 to 5 year cycles today. And I'm a sponsor. I raise capital for deals. We invest in properties, and the nature of the business is sort of short term thinking, right? You do 3 year bridge loans,
Yes.
and a lot of guys, unfortunately, right now are going through really difficult times with
They're
the 3 year
hurting.
bridge loan product. They're hurting. Texas, where you are, is having a lot of issues right now, and Austin specifically is kind of a
Yep.
market I've been talking about a lot. The commonality I find in the stories is a long-term orientation. And by long-term, I mean like long-term, like a long perspective on how long you're going to own something. So long-term orientation, strategic and careful use of leverage, right? So the people, like I always say this to folks, like this is a fantastic way to get rich, real estate. And there's a lot of reasons for it, right? The nature of fiat currency, the nature of like a systemic
Right.
debasement of our paper money lends itself to this asset class. But it's also a really good way to go broke because it's relatively easy to get into, and you can do it with relatively risky loan products. And some of the guys I've had the pleasure of meeting in this day and age, I have a mentor in the Pacific Northwest who owns 3,000 plus units. He's been in the business for 55 years now. And I asked him one time, what's the secret to like your success? And he's like, low leverage,
And
low
that's
leverage.
that
Yeah.
is one of the things I was talking to the president of the bank yesterday. What I appreciated about your book, I called it a very conservative, still using leverage, but still a conservative approach. And like what you're saying, the wealthy think in, I say decades, but sometimes almost in 100-year spans. They're thinking in decades plus
Right.
in how they're doing it. And so they're managing leverage. I always use the term the right amount of leverage that doesn't put the property in jeopardy. And I share, and I know it's not popular because the easy sell is high leverage, get in with very little money down.
Right. Right.
And I'm teaching what I'm looking at now. This is from a small investor starting out as a loan to value at 70%. or less because
Right.
you have a path out. Even if your assumptions, you stress test it. You talk about that in the book. You stress test the numbers. Even if you do that and you're at 70%, you have a path out.
You have a path out. Agreed. And the thing about this business is like surviving is the game, right? Like it's like Charlie Munger says, never interrupt compounding unnecessarily, which I think is a great financial quote
Excellent.
for life and for everyone, right? But one way you interrupt compounding unnecessarily is over leverage your deal and then you're forced to fire sale it. If you can build longevity, and look, I recognize like I want to touch base on what you just said. It is true when you're early and you're getting into this business, like most people are capital constrained to buy something.
You're right.
So there is a fine line where people do have to take slightly risk. They might have to take a riskier deal just to get into a real estate deal and get their first deal done, which I totally respect and understand. And I've been there. I've done the same thing. But the commonalities, to circle back to the original question, the commonalities in my opinion are long-term orientation. And the other thing you see across time and history with nations and with people is it is a cycle of the wealth creator, their children usually inherit the lessons of the wealth creator, but then the generation three, generation four, they kind of forget the core lessons, and then um, they cause a lot of problems for themselves, right? Like they over leverage, they do something that was against the principle of the original founding patriarch or matriarch, whoever it may be, that started the business. And we see the same thing in nations, which is something I write about a lot, which is empires go through the exact same cycle. They start with the creators and they understand the principles of building something great. The next generation remembers those principles and they apply it, but inevitably they forget. And you can see that cycle across families and you can see that cycle across empires. It's the same cycle. And when I was at Goldman, we used to have a saying. I don't think it's a Goldman saying, just a saying, but your first generation is the wealth creator, your second generation is the maintainer, your third generation sort of loses it. And having worked with many very wealthy families, you can see that play out in real time. There's very few families that have solved for continuity over time. And I don't know, there's many culture, like the culture within the family, the way they structure things, but those two, right? And
You're right.
yeah, and the thing that you see is, and it doesn't always happen that way, right? Like one of the stories I shared is on Marcus Licinius Crassus, who was the wealthiest Roman real
Right.
estate guy. It's actually one of the coolest and most interesting stories. But he's a really prime example of this thing where like you can't stop. Like you forget your core principles even in the first generation and you just go too big, and then in his case obviously the ending was a gruesome death, right?
Right.
but that you see that today. I mean, I've seen first generation wealth creators today that bet too big recently and they're going through bankruptcy now, right? So it
It's
so
struggling. I think we all do in our life. When is enough enough? If you
right,
keep that in perspective, you'll start learning when to pull back. And I have to fight that too. We all do. When is enough enough?
right,
Because if you're striving, 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 eventually you're going to compromise something. And
right,
the ultimate
yeah,
goal is to grow the wealth, but then also retain it.
yeah. Well, yeah, and I think a good test is to say, you know again, I'm empathetic to like starting because every deal
You're
is
right.
quite risky because you have a lot of capital into it. But if you're ever at a point where you've made it, then I think the question on every deal is, if this deal goes wrong, does it bankrupt me? And then if that's the case, then don't do it. Like then don't take that level of risk. But there are guys that can't stop themselves and they're in that situation today. I'm not going to
You bring
name
that
any
up in your
specific
book.
stories.
You
Yeah,
you actually show all of this. That's what I loved about the book. You've put history and then okay, let's tie it into today. How should we live then today off these lessons? And that's what I
right.
loved about it. It taught very good principles. Do you think your views on anything evolved as you prepared the book, or did it just validate what you knew?
Yeah, I would say they've evolved. And part of the evolution is also, I'm started my company in between the last cycle downturn and this cycle downturn, right? So I think myself and many other sponsors of this generation are learning the negatives of bridge debt, right? And so myself and other people have all taken on bridge loan type deals on properties in 2020, 2021, 2022. And we've been very fortunate. And goes back to what I think is some of the values of investing in these sort of disfavored markets, right? We've been very fortunate that we've been mostly able to navigate those without a ton of trouble, right? We're seeing a lot of those bridge type loans blow up right now. And the Sun Belt is a market I talk about often, but in
Right.
those markets where there's a lot of pain because they got really the pricing ran ahead of the fundamentals in those markets, and the narrative ran ahead of the fundamentals, and the pricing got out of whack, right? Um, so one of the things I kind of took away from the story and the research and the learning was it like surviving. I guess I already said it. Surviving is the name of the game. You have to survive. If you can survive cycles, you will become successful in this business. But surviving is everything. And there's so many negative incentive issues in this industry, especially if you're on the raising capital side, to try to engineer higher returns, partly because your pay depends upon it, but partly because investors won't put money into a deal that doesn't have the return profile of other deals. So there's this constant pressure to like do this.
To get all the
And
return now and who cares about later?
yeah, yeah. Well, it's interesting. Like I just toured a building we're looking at acquiring, just to give you an example. And they have great occupancy. It's not in a great location. They have great occupancy and low delinquency on rental payments. And I was like, well, and they're like, they have great retention. I said, well, what's the secret? And they were like, we don't max the rent. Like we figure out where the market is and we go a little under it. And that's sort of anathema to most people because we're all in this society today. We're all about min maxing everything. Like if I can get $1,500 for this unit, I'm going to go for 1,500. And if I can get 1,525, it's awesome, right? But if you went to 1,450 and you left return on the table, people might be like, "Why'd you leave return on the table?" But like
But
we're
you get the consistency and stability. That is so funny you bring this up. I literally was talking to my property manager about one of mine.
Yep.
So it turns over quite a bit, and I was fighting against that natural tendency. And I said, well, I've decided now to go for rents slightly under market to keep the stability, so that if they're wanting to move or even look, they can't find anything cheaper for the same quality. They're going to stay. I end up netting more. And
Right,
that you're
right.
dead. I literally was talking about this on Monday.
That's amazing. Yeah. Well, it's the truth. And the issue in the multifamily business specifically is giving up that rent that you could have gotten translates directly to your NOI, which translates directly to the final valuation, which you're not going to get the value of lower rents on the next buyer coming into the
Right.
building. So, but that goes back to short term versus long term thinking. Short term thinking is how do I min max an asset to exit at the best possible price so my promote is good and my investors are really, really, really happy with the return. But survival is the name of the game, and that's what you learn in history. Is like the families that survived for hundreds of years, like the Grosvenor family, for example, who I wrote about as well,
Right.
and did a podcast episode on as well. They've been in the real estate business for 350, 400 plus years, and they have owned the same assets the entire time. And people commented like, "Oh, but your return drops to like it drops to nothing over that time." And I said, I don't see it that way. I don't think that's accurate. And like they've compounded their assets for a very long time, and they were never fixated on the 5 year cycle of exiting, right? And so yeah, I mean
Well,
like so my view evolved on that. I used to be a min maxer. I mean we had one of my first deals I ever did. We did a value add project in Portland, 23 units, renovated the whole thing. I maxed the rent. It was awesome. We were like, oh, this is huge. Like we got the top rent possible for those units. Got an appraisal done. It was a $3.1 million purchase. We reappraised at 5.2, put a nice new loan on it, returned a ton of capital to investors with a cash out refinance. We have an incredible like loan on it. But the next year to 2 years on that deal were really difficult because all those residents started turning and moving out, and our vacancy was high. And then it was like the cash flow kind of dropped. And it made me realize like what was the point of min maxing the rent? If I had gone a little bit lower, we would have just produced steady, reliable cash flow, and it would have been a better outcome for everyone. So, yeah, it's an evolution of my perspective for sure.
And literally, I'm having the same evolution too. One of the things I wonder if the wealthy understand that they already understand that maybe some don't is that here in the United States, the IRS taxes income, not wealth.
Right,
It doesn't tax wealth. So if
right,
you're looking at that property as a bank account and you're building the wealth, you're getting the right amount of revenues, but understanding over time the wealth of that property grows, but it's not being taxed unless you sell it.
right,
So
right,
leveraging understanding the tax code that we're trying to get the right income, but also growing the wealth because the wealth isn't taxed.
right. Yeah. Well, yeah. And I'm sure you remember one of the chapters in the book kind of dives into why governments incentivize real estate ownership and
Yes.
why that's so important. And I mean, there's many factors for it, but one I'll just highlight. The government wants you to own real estate. They want you to invest in property. They create tax incentives for you to do it. There's many reasons why. I hit on, stability of society, people needing to own a
It,
stake
yes.
in land. But I think one of the I always say I think real estate investing is like the force. It's everywhere. And the flow of capital into cities is what keeps the building stock of those cities renovated and improved over time. If the government made it uneconomical to invest in property, property start to deteriorate. Electric systems go unupgraded, pipes start bursting, the siding of the buildings start to fall apart. There's a massive, like, just one of many reasons why the government actually encourages us to invest in real estate is because who else is going to do it? If you make it difficult for the capital to flow into these cities,
Right.
cities start to deteriorate. And you can see that, by the way, in places like Berkeley. I'm going to call Berkeley and Oakland out specifically in California. They make ownership really difficult and really uneconomical. And you can see when you drive to those cities a lot of deteriorating housing stock. And it, like, that's the end result. Like, that's what happens. Like, the housing stock deteriorates. So um, that was kind of eye opening as well as I researched that and thought about thematically, like, why historically do governments always incentivize land ownership? And
That
and
was
there's many reasons why.
that was the big light bulb went off in for me in that book. And I told several people about it is you go all the way back to the Roman Empire and show that there was tax incentives for real estate all the way back to then, probably even before then. You went back centuries and showing that tax incentives by government have been there through the centuries, and
Yes,
now you explaining parts of the reasons why, and the government's telling us here's the opportunity, take it.
right. Yeah. Well, and I think the stability and strength of nations, not to get really high level thematic, but I think the stability and strength of nations is highly dependent upon a strong and robust middle class that is able to own property. And when that
I agree.
piece goes away, I think societies fall apart. And I don't remember if I highlighted this anecdote particularly in the book, but one of my favorite, there's a fantastic trilogy by John Julius Norwich on the Byzantine Empire from the start to the fall of the Byzantine Empire. And the moment at which the Byzantine Empire, for those that don't know, is the Eastern Roman Empire. So when the Roman Empire broke into two pieces, the Western Roman Empire fell. The Eastern Roman Empire continued on for 1,000 years. We call it today the Byzantine Empire, but all of their contemporaries knew it as the Roman Empire. It was just the continuation of the Roman Empire. Most people don't realize. And then Constantinople fell, 1,000 plus years after the fall of the Western Roman Empire, and we call it Istanbul today. But there's many factors, but one of the big factors that caused the decline and fall of the Eastern Roman Empire was lack of property rights for the common man in the empire. And
You
the
do
really
mention
tragic,
it somewhere in the book. I don't think you use the Byzantine Empire, but you do mention when the middle class didn't have property rights, society began to collapse. You do mention that a little bit in
yeah,
there.
yeah, well, yeah, okay, yeah, exactly. And the specific anecdote that I've always found to be tragic and really fascinating is there was a particular Roman emperor. that was trying to expel the Turks from Anatolia, which is the Asian landmass that's now Turkey. And this land was the breadbasket of the Eastern Roman Empire. And historically, the way the Romans defended the frontier was to give farmsteads to legionnaires, so they had their own plot, but then they were wedded to the land, so they would protect
Defend
the
it.
land. They would defend it. But what happened over time, and this happened on the Western Roman Empire as well, which is the kind of the story of the Gracchi brothers, which is a whole other thing. What happened over time is the big noble houses started to acquire large stakes of this land and turned it into kind of fiefdoms where they had serfs working the land, but there was no loyalty to the land. And the legionnaire, there was no like population base anymore. All the land went to these groups. And so this emperor, he was fighting against the Turks, and he was planning to redistribute the land, which in this day and age, land distribution doesn't sound great, but the
Right.
premise was that basically these families had taken too much. And at the Battle of Manzikert, which was kind of the massive turning point for the Eastern Roman Empire, he was winning the battle, and his nobles betrayed him and left, and they fled with their cavalry, and the Eastern Roman Empire was defeated in that battle, which was kind of the downfall of the whole thing. And his goal had been to ensure the common man and the empire had access to property rights and land. And it's an interesting story because the Turks captured the emperor. They treated him very courteously. They did this whole like ceremonial thing, and then they had tea together and stayed together, and then they sent him back to Constantinople. Well, when the emperor arrived back in Constantinople, his nobles blinded him and sent him down to the river to die. And that was sort of the end. Like, I look at that and I say, like, when empires make it hard for people to have their own stake, the end is sort of, it will take a long time. It was a long time from that before it actually fell, but it was the turning point. And so, anyways, that's a good history lesson.
There
So
you go. Let's tie it back to today, and kind of my audience are smaller investors similar to me. So your book discusses a conservative approach, and that's one of the things I appreciate to wealth creation when discussing both debt and diversification and liquidity, because you have that in there too. How would you counsel someone just starting out, or they're further along in their real estate journey? How would you give them counsel based off of this book?
I think, first of all, you have to understand your own market. So there's a lot of people, I know many people that invest, across the country in a different market, and I'm not sure their level of fundamental understanding of the place they're investing. None of the great wealth creators in history built their wealth by owning property in some faraway place and kind of acquiring it from a distance. They were there, right? The example we talked about with Marcus Licinius Crassus, he was there, right? John Jacob Astor was in Manhattan. He understood the story in Manhattan. So first of all, I would say niche down. Don't don't get distracted. Don't try to do a bunch of different things. Understand your market intimately, right? And I would counsel people to try to invest locally, right? Even if it's not the best, like if there's again, on this min maxing idea, like, yes, maybe you can maximize your returns better in another market and it's more attractive, but there are good deals to be found in most places. So local knowledge, really important, really understanding. I think there's a lot of value. So I will say, full transparency, I was very much raised in and schooled on the concept of handing over management to a third party management company. And I grew up listening to Bigger Pockets and reading all the same books that you and I, am sure, have both read. And the constant refrain is, this is actually an evolution of my thought process too, but the constant refrain is you can't scale your business if you're also managing the properties. So you need to just give it to someone else and then keep buying properties. And that's how you scale. I think it's true to an extent, but I would actually push back on that narrative a little bit and say controlling the processes on like your first deal, right? If you buy a duplex as your first property, I would say, like, I understand and am empathetic to the idea that you don't want to buy a job. I get that. At the
Right.
same time, you learn so much from managing and controlling it yourself and really understanding the processes. So I'd say, like, start local, do it yourself, or if you're going to hire a management company, be very involved with what they're doing. I think that the general example I took from history from studying this was that people had a lot of focus to start, so they didn't scattershot approach how they were thinking about it. They were like good at a thing and they did that. Eventually, they diversified. We talk about diversification, but diversification can be intra-market, right? You can have different neighborhoods in your city. Like, and diversification in real estate to me looks like maintaining adequate cash reserves, which again, in theory is
Which I
great. I understand.
appreciate.
Yeah, which is huge because you can go broke with good deals if you run out of cash. On the other hand, I understand that when you're starting out, it's hard to have ample liquidity. So there's a give and take here on this process. But I think those are the things I would mainly like if I were starting, I would focus on. And I'm sure most of your audience is already aware, but I always tell folks if they're getting started, and I think especially if you have either a supportive spouse that buys into it or you're single, to me, the best first purchase is a live-in house hack, buy a fourplex or a
I do too.
triplex with
Yeah.
the 3% down. I never did it because I was married when I bought my first place and my wife didn't want to live in a fourplex. But, and again, I'm saying this is why you got to have the right kind of partnership set up for that in the first place. But to me, that's a great way to start. Hands-on experience, low capital down. You're still coming out ahead because your living costs are down. Like that's the way I would approach it to start.
And that's what my wife and I did. Our very first property we lived in was a duplex. We lived in one side and rented out the other and
Yes,
gave me
amazing.
that taste. And you're saying you're learning it from firsthand experience. One of the things I appreciate in the book that you put in there, and I actually have used it on video, so
Okay,
you know,
awesome.
is concentrate when you're building your wealth, get narrowly focused, and in our group that we're in, knowing your buy box intimately.
Yeah.
You know it so intimately. And then you diversify once you've really acquired that wealth. But then you even talk about knowing when to start that diversification is a little bit of a art and a science all put
Yes.
together of knowing
Yes.
when that is. So I
Yeah.
know I appreciate that. One final question. Let me find a good one. Okay, here's a good one for the end. So if you were to go back and write the book again, is there anything else you would add to the book? Or is there going to be
I,
a second book down the road?
I am working on another book right now, with a slightly, I guess it's sort of a sequel to the book. It's going to be called The Timeless Way, and it's going to basically be a principles focused book, kind of the premise of this conversation. Like, what are the principles of great wealth founders, wealth creators over history that they applied to what they do? I dive into it a little bit in this book.
You do. You do a good job at that.
There's a chapter at the end that's like the common traits, but the next book will focus, each chapter will have a much deeper focus on like a trait that is necessary for great success that is evidenced across history. So I am writing my next book. I expect it to be done towards the end of the year, so stay tuned for that. Yeah, I mean, I think as I've progressed further here, the whole timeless investor brand that we are building here is about this, right? Like great stories, applying history to the modern day, looking through a historic lens. And as I've done further research and met and encountered more historic wealth creators, their stories are all amazing. And I post about them on LinkedIn. I post about them on my Substack. We do these long form stories. So yeah, there's definitely more families that could and should be mentioned over time. And there's many more that I haven't even discovered yet that I'm just like starting the research process on and learning about. But there's definitely more people that could be included. I'll say that.
Good.
They'll be in the next one though. They'll be in the timeless way when it comes out.
I'm looking forward to it. I've got it behind me, the Timeless Wealth book. Man, Ari, thank you for your time in this discussion. I look forward to continuing to promote this to all kinds of generations because I think it's a good lessons that we can learn from history and see those trends of who had staying power and what those principles are.
Absolutely. Well, thank you for having me. It was a pleasure to be here, and I appreciate the time. Thank you.
Thanks, Ari. Bye.